Hey guys, in this video, I share our December update of our $111,000 TFSA dividend stock portfolio. I'll show our 16 holdings and which stocks we bought to take advantage of the bear market. I'll also share the performance of each holding we own in 2022 at the end of the video. Let's do this! For those that are new to the channel, my wife and I do our finances together. We have 3 accounts through 2 brokerages for our TFSA, Scotia iTrade and Wealthsimple. As you can see in our Wealthika account, the month of December has been good, but bad for our year performance. We finished the month down 3% and are now down 13% from our highs in April. The S&P 500 finished the month down 5.9%, bringing its 2022 return to negative 19.44%. I can proudly say I beat the market by more than 14% according to Wealthika. According to my spreadsheet, I finished the year negative 2.2% or 17% better. I can't make out if the error is on my spreadsheet or Wealthika's, it doesn't really matter. With the high interest, high inflation environment, it's going to be a rocky 2023, and I can't wait for it. Let's get right into the update and start as we always do with our one and only ETF in our TFSA. VFE, Vanguard's non-hedged S&P 500 index ETF. Since selling off most of our position, we have not made any purchases. VFE pulled back 5% in December. I still see the index as overvalued, so it's really hard to buy back our position at present. Hopefully the market pulls back again come the new year. Right now, VFE makes up a tiny 0.2% of our portfolio. I have an allocation target of 5%, so we still have a lot of work to do. Next, CANOE EIT Income Fund makes up 2.8% of our portfolio. This income fund has performed very well so far this year, with its many high-quality blue-chip stocks presently in favor. And with a portfolio weighting of 21% in energy and 21% in healthcare, they have weathered the storm amazingly well. I have a target allocation of 0%, so one day this will be sold. Next is our ugly duckling, ALGONQUIN Power and Utilities Corp. This is our renewable energy play in the utilities sector. This makes up 3.8% of our portfolio. ALGONQUIN became headline news when it released Q3 earnings at the beginning of November, and is still the talk of the town for all the wrong reasons. I read through the earnings report as well as the MD&A, Management Discussion and Analysis, and posted a short video of my thoughts. Here's the link if you want to watch it. Investors Day is also coming up at the beginning of 2023. There I'm anticipating a dividend reduction of 33%. I've mentioned it on Blossom Social. If you haven't done so yet, download the app for free on your phone and follow me. It's an awesome social investing app. You'll be able to see all my trades live and rationale for some of them. I hope to interact with you guys there. Next up is our third worst performer of the portfolio, FIERA Capital. It represents 4%. FIERA dropped 2.5% in December. This remains on the chopping block. I think they'll continue to struggle in a difficult financial market. They released Q3 earnings at the beginning of November, and they were okay as I mentioned last update. AUM, or assets under management, actually increased compared to Q2. Q4 will be really interesting. It'll be alarming if their AUM continues to drop. So all in all, I'm still waiting for my exit price. I'll take my dividends in the meantime and invest them in other better value positions in the portfolio. Next, we have MANULIFE Financial Corporation at 4.5% of our portfolio. We used to own a few stocks in the insurance industry, but no more. We have a 5% target weighting on this position. MFC reported Q3 earnings in November and they were bad. I was surprised the market didn't react stronger than it did. MSC delivered core earnings of $1.3 billion in Q3, a decrease of 14% compared to Q3 2021. They still haven't announced a dividend increase, and I can imagine why. With the decrease in EPS, earnings per share, their quarterly dividend payout ratio increased to 48.5% from 41% the year previous after a major bump up in the dividend. We should have made some purchases back in October, as this has run up 14% since its low. There are still some real risks in Asia with this holding, but it is a manageable risk in my opinion. And believe it or not, this finished the year flat and with its dividend returned 5.6%. Next up, we have TELUS Corporation at 5.1% of our portfolio. This is one of 2 in the telecom sector for us. We have a target weighting of 6%, so we still have some work to do with this one. TELUS reported earnings at the beginning of November, as I mentioned last month. Earnings were great, and it showed how they have pricing power to beat inflation. Revenue was up 10%, EPS 17%, and total mobile and fixed customer growth of 347,000. We are getting closer to equal weighting with BCE. This finished the month down almost 9%, so we bought 9.93 shares at an average price of $27.17. That added $13.94 to our forward annual income at a yield of 5.2%. I didn't take full advantage when TELUS was flirting with its support levels in December and even dropped below its 200-week moving average. That was for those that like to follow TA. Next is our OG utility, Fortis. It represents 5.5% of our portfolio. This has been a strong performer for us over the years, despite finishing this year negative 7%, not including its dividend. After selling off $1,200 worth in September, I want to add back more to balance it out with CPX. Fortis has been on a run like the rest of the market since it bottomed on October 12th, up 10.5% to finish the year. We dripped one share with a 2% discount at $52.76. This increased our annual dividend income by $2.26 at a yield of 4.3%. This is one of the reasons I like having drip for some stocks. Those little discounts really add up over the years, if they make sense. I'm a selective dripper. Next up, we have BCE Inc. at 5.6% of our portfolio, about 0.5% more than our TELUS weighting. We have really narrowed the gap between the two, as I mentioned. We have a target allocation of 6% for BCE as well. It remains a core holding of our TURF model, telecoms, utilities, REITs, and financials. BCE plummeted 7% on the month after the bounce back from its low in October. Q3 earnings were good, just not as good as TELUS as mentioned last update. We bought a whopping $3.36 worth at a price of $60.32 a share, adding 20 cents to our annual dividend income at a yield of 6.1%. If you're wondering why the small amount, sometimes we have leftover cash in the account after buying with our dividends and decide to reinvest that pocket change as it does add up over time. If you're liking this video so far, please hit that like button for us. It will be really cool if this video can break the 100 like mark. Think we can do it? Next, we have one of our midstream pipelines, PEMBINA Pipeline Corp. It represents 6.7% of our portfolio, down from 7.1% last month. Q3 earnings in November were good and guidance for the year was boosted again by 2%. Some big news was that beginning in 2023, PEMBINA intends to move from a monthly to a quarterly dividend payment. So if you hold PPL, our next payment will be at the end of March. On the month, PEMBINA dropped 6.5%, and yet it still finished the year up 20%, not including its dividend, finishing as our best performing stock. Who could have thought at the start of the year that this would happen? Time and again, the dogs of the Dow method for stock selection in conjunction with solid fundamentals has done us well. We made no purchases as this is already over our 5% target weighting. Next up, we have SmartCentres Real Estate Investment Trust at 6.9% of our portfolio. This REIT is another staple in our TURF portfolio. This is overweight for our liking as we have a sector allocation of 15% for REITs and right now we're sitting at over 20%. We consider SmartCentres to be one of the top 4 REITs in Canada. It reported Q3 earnings in November, and the one highlight I mentioned last month was the payout ratio relating to cash flows provided by operating activities for the rolling 12 months ending September 30th, 2022 was 86.6%, as compared to 96.8% for the same period ending September 30th, 2021. SmartCentres finished the month of December down 3% and finished the year down well below the market at negative 15%, not including its dividend. I'll hold this position for now as I see real estate rallying hard in the new year. Next, we have our OG pipeline, ENBRIDGE, at 7% of our portfolio. It reported Q3 earnings in early November and they were good. And at the end of November, they announced an annualized common share dividend increase from $3.44 to $3.55 per share, or a 3.2% increase, effective March 1st, 2023. The stock finished the month down 4%. It still beat the broad market with a return of 7%, not including its dividend, as our third best performer of the year. I am happy with where this is positioned in the portfolio right now. Next up, we have First National Financial at 8% of our portfolio. Despite the drop in net income for Q3, FN increased its monthly dividend by 2.1% as we reported on the other month. The stock finished the month of December flat. It has run up 10% from those November lows though. This could stagnate at these price levels for a long time by my reckoning with these elevated interest rates. But once they start to drop, this will rocket. In any case, It finished the year down 9.8%, not including its dividend. I still like this small to mid cap play and will continue to accumulate shares when it's undervalued substantially. Next up, we have our mid cap utility, Capital Power Corp, at 8.2% of our portfolio. This was on a tear, trading up 20% from the lows of October, only to pull back again. It finished the year relatively flat. This was our second best performing holding in our TFSA with a total return of 23% including its dividend. With this running up so much, I may trim this position to add more to Fortis, balancing the two out. If it pulls back substantially, I may add again, as I did sell off 58 shares at an average price of $50.61 back in September. Next up, we have TC Energy Corp at 8.5% of our portfolio, up from 7.7%. This is down 18% from that big rally in November. It finished December negative 8%, but on the year still beat the market with a return of negative 2% when accounting for its dividend. TRP reported Q3 earnings in November, as I reported on last month's update. The one key I liked was the reaffirmation of their 3 to 5% annual dividend growth, despite some cost overruns on their Coastal GasLink project. I have this as slightly undervalued and will accumulate slowly at these levels. I have no plans to tranche big money into this overweight position though. We bought 3.18 shares at an average price of $55.74. That added $11.43 to our annual dividend income at a yield of 6.5%, just about in line with our rule of 12. Next up, at 9.8% of our portfolio, is Bank of Nova Scotia. This is our second largest holding, though I still wish it was TD. The share price finished the month negative 5%. Q4 earnings were released at the end of November, as I commented on last month. No one was surprised by the lack of dividend increase, as the payout ratio is now above 50%. This finished the year as our second worst performing stock of our portfolio, down 26% not including its dividend. I believe BNS is undervalued at this level and presents the opportunity for some much needed capital appreciation compared to its bigger and albeit better friends in TD and Royal Bank. And at the same time, we need to build up a position in TD or Royal when the opportunity presents itself. And at last, our largest holding is still RIOCAN Real Estate Investment Trust. It is now 13.5% of our portfolio because of the run-up in price. This has remained our largest holding since the pandemic. RIOCAN has also been on a tear since hitting that bottom in September, up 19% at one point. It finished December relatively flat though. Its 2022 return was negative 3.4% with its dividend. I was impressed with this, as the real estate market and anything in it is under a lot of pressure. I mentioned in my TFSA income update in November about Q3 earnings. They reaffirmed 2022 FFO per unit growth guidance of 5 to 7% and are expecting to be at the higher end of the range. The FFO, or funds from operations payout ratio, of 56.7% was in line with their long-term target range of 55 to 65%. We can now anticipate another modest dividend increase early next year, inching closer and closer to the previous distribution of 12 cents a month. I'm not loving RIOCAN's valuation right now, but it is still undervalued by a good 20% by my calculations. We were able to drip 2 shares at a price of $21.02. That added $2.04 to our annual forward dividend income at a yield of 4.9%. So there you have it, all 16 holdings and what purchases we made in December with our dividends. We deployed a total of $545.04, adding $29.87 to our forward annual dividend income this month at an average yield of 5.5%. If you haven't watched our December portfolio income video, check it out in the description below. You will notice that we earned more than we spent this month. We have been building up a little cash position in our iTrade account to go along with the $60,000 in TFSA room we have in 2023. And lastly, here's a chart showing all of our holdings and their returns for 2022 without their dividends. It is nice to see which positions and sectors held the portfolio up during this crazy year. When you include those juicy dividends, it looks really good. 5 of our current 16 holdings were green, and only 2 of the 16 were worse than the S&P 500's return. If there is one standout that shocked me, it's CANOE EIT Income Fund killing it yet again. Robert Taylor, you killed it. Shame on me for wanting to sell you. Thank you so much for watching and helping the channel out by smashing that like and subscribe button. Until next time, I'm Mr. Financial.